Coachella Valley, and welcome to Live with Your Chamber. I'm your host, Katie Stice, CEO at the amazing Rancho Mirage Chamber of Commerce, and we have a special live for you this week. We have an economic update because we've been talking with our local business owners, forecasters, and everyone's really focused on the future, what we can expect, what we can look forward to. And so we reached out to our membership because we have a lot of experts here to bring you the latest information. So if you're tuning in, please leave us a comment, let us know where you're watching from. And I'm going to bring in our first guest today, who you probably already know, David Morgan with Capstone Partners Financial is one of our amazing members and one of our ambassadors as well. David, welcome.
Hi, thank you so much. Good morning, Katie, and thank you the entire Rancho Mirage Chamber of Commerce and the entire community. Very excited to be here today, a part of this. Very excited to showcase Daken, who you will see very shortly. He's very cool. He has a beard. Beards rock. So, it's funny, talking about the economic status of Coachella Valley, a lot of clients always say, why do you always talk about, everything that's happening around the world? And, it's a very good question. We want to know about what's happening local, but very important question to know is, I want to ask you if you remember, say, spring 2020.
Yes.
Think back. There was a lot of challenges. One big challenge other than COVID was the supply chain. And the supply chain was a big mess, especially I have clients here locally that were very affected. I have a gentleman that owns a business in Palm Desert, a medical supply company. Where do medical supplies come from? China. 95% of his product comes from China. And so he had a very hard time for many months getting product over here so he could sell to his clients locally. And what happened eventually is the product that did reach Long Beach, sitting out there in the harbor, it was then confiscated from the U.S. government.
Oh my gosh.
So he had a problem trying to reach and trying to help his clients. But, if it's anything that's happening with China or if it's anything that's happening in Russia and Ukraine, we have to think of how does that affect us here locally. I mean, one big thing, look at all of our car dealerships here in Coachella Valley. We have many car dealerships. Think about all the cars that are not on the lot right now because of supply chain issues. That's affecting us locally. Think of the car dealers not making money. Think of the salespeople that aren't earning commission. So again, if it's China, Russia, Ukraine, or anything that's happening, we have to really figure out what's happening globally because we're such a global economy. But today, we're very lucky. We're very lucky to have an expert here to discuss. So Daken Vanderburg, please note the beard, has over 20 years experience and is our Chief Investment Officer for MassMutual Trust and Head of Investments for MassMutual Wealth Management. Capstone is proudly a part of and a member of MassMutual. Daken is a graduate of University of Pennsylvania and Columbia with coursework in statistics. That means he's very smart. And he completed his MBA at MIT and has a business administration degree in finance from University of New Mexico. And he's a CFA, certified financial analyst. So please allow me to welcome Daken Vanderburg.
Welcome, Daken.
Great. Thanks, David. Thanks, Katie. And great to see everyone. Good morning. We've got an exciting agenda here today. We're going to dive right in because there is a lot to cover. As you might note from your daily experiences and watching headlines, we've had the worst bond market in the last 50 years. We've had a sell-off in the S&P. We've had the first military invasion since the end of World War II. We've got consumer sentiment that's dropping. Growth is slowing. China's got all sorts of difficulties. It is a complicated, dynamic, confusing, and somewhat fearful market. So here's what we're going to do. Today is not about a political agenda. Today is not about even a predictive agenda. Today's really not even going to be comprehensive. We're going to try to use data and use some lenses of history to try to inform where we are and to help you make better decisions so that in your daily businesses, in your daily investment decisions, and in hiring and firing, all the things you have to do as engagers of this society and economy, you can make better decisions by having better information at your fingertips. So let's go ahead and dig in. We've got three main sections. We're going to start first on the Russia-Ukraine invasion. It's important for a whole bunch of items, mostly because it's putting lots of inflationary pressure on the world. And I want to make sure we're clear on what that looks like. Number two, we're going to dig into inflation a little bit. I think you'll hopefully have a slightly different view of inflation than maybe when you began this call. You do not need to be an expert in economies or in economics. I will slow this down. I'll define it for you. And then we're going to give some perspective on what is likely to come out of this. And then three, we're going to zoom out. Let's look at history. So what have we learned in prior inflationary environments? What happened in the late 70s that we can learn from? And how do we think this might play out? And as we go through this, each time I'm going to really try to stop and make sure you understand the impact. What does this mean for you? So history lessons are useful, but only to the extent we can make better decisions. And so I'll try to walk you through what are the impacts or potential impacts, and what are things we should be thinking about, both in terms of investment portfolios as well as an economic impact or potential modes of this essentially playing through. We'll spend a lot of time on those three sections, and then we'll open it up, as always, to questions, and we can engage from there. And David, feel free to jump in, of course, when you feel free. So
Thank you.
Section 1, Russia, Ukraine. What do we know? Okay, so some of this will be redundant. Just after 5 a.m. Kiev time on Feb 24th, Ukraine's government reported it faced full-scale attack from multiple directions. We're now 3 months out. As you know, the world has grown a little numb to the daily headlines, yet it's really impactful in a whole bunch of different dynamics, right? So that chart in the bottom right is probably the best picture I've seen of what happened on the morning of Feb 24th. Now, on the eastern border of Ukraine, Russia had been lining up its military engagement for really several weeks before. In fact, if you go back and study Russia's history, over the last 22 years, Putin has been talking about how he wanted to erase the mistake that was Ukraine. So this was largely signaled, and markets had largely adjusted before this all occurred. 4 lenses to explore this with: military engagement, humanitarian, which is oftentimes the pressure point by which these invasions stop, Western sanctions, Western support. I think I'll offer a slightly different perspective than what you may have seen so far. Military lens, as of this morning, the big takeaway so far is Putin and his military, Kremlin in general, vastly underestimated the ability of Ukrainian citizens to band together. Zelensky has been remarkable at pulling together resources. There are now more surface-to-air missiles in Ukraine than the entire rest of the world. It is a remarkable aggregation of support from military powers worldwide that very much walked this line between offensive weapons and defensive weapons. U.S. was only willing to send defensive support as opposed to offensive support. Initially, attacks were countrywide, and we've now transitioned to phase 2, almost to phase 3, where Russia captured a significant portion of the north, the south, and the east, a little bit of the west. That's changed remarkably, and Ukrainians now captured back a number of different cities, both along the north and the south. And now what you have is almost this phase 2, where Russia is really looking for this corridor. You might remember back in 2014, Crimea was annexed. The world largely ignored it. We now have this corridor over to Russia, goes down to the southern port of Ukraine in the Black Sea. And yet, Ukrainians continue to fight back and gain progress. And some significant damage has been incurred on Russian troops. There are now more than 11 generals that have been killed. There are far more troops that are Russian that have been killed in this invasion than there have been Ukrainian. And you might have noticed, notably, Moskva, which was the crown jewel of the Russian Navy, has been sunk in the Black Sea. Remarkable change of events that really Putin did not expect. Still very aggressive, starting to discuss this concept of annexation, potentially creating this corridor. That could be one path to resolving this, although Ukrainians are very against that for understandable reasons. Section 2, humanitarian lens. The reason I touch on this, not only is this a tragic and an arrogant war to have taken place, the humanitarian lens is the one that oftentimes will push other powers to get involved. We're watching this very closely. So far, the United States and China have very much signaled they have no interest in getting involved militarily. I will say the thing that can often change that is when large death counts begin to occur. As of so far, as of this morning, more than 6.4 million Ukrainians have fled Ukraine for neighboring countries. More than 4 million Ukrainians are internally displaced. Remember, the entire population of Ukraine is around 30 million people. So we're talking a very significant displacement and loss of talent that has now left Ukraine for neighboring countries. Poland has accepted more than 3.5 million Ukrainians. And tragically, and these numbers are very difficult to get accurate counts on, of course, more than 12,000 citizens killed. It looks like more 15, 16,000 are more likely. More than 4,000 Ukrainian and more than 15,000 Russian troops killed. That's as of this morning. We're watching this closely again because this can oftentimes put pressure, particularly if Putin is backed into a corner and were to use something like tactical nukes or something that he's threatened at some point. Let me turn a little bit to the financial sector, because this was the one that was so dramatic and I think so unexpected. The coordinated efforts to freeze roughly $630 billion of the central bank of the Russian Federation. That happened within 2 days following this invasion. It was almost unprecedented for foreign countries to seize the assets of the central bank of the Russian Federation. Remember, central bank is the bank of all banks to Russian banks, and immediately pulled Russian banks out of about 80% of their economic ability. In other words, basically within 12 hours, 18 hours, depending on how you count, we had totally removed the ability for Russia to have a banking system. A remarkable turn of events. That has all sorts of pressures and ancillary issues I'll touch on in just a moment. Item 3, Russian bank responded by banning foreign debt repayments. The U.S. Treasury is now pushing Russia towards default. This Friday, there's a very significant bond payment due, and you may have seen the Treasury through OFAC essentially said we're not going to allow Russia to do what it wants to do. And so they're pushing Russia towards a default. If that occurs, the ability for Russia to borrow money worldwide is almost removed entirely, which will crush the Russian economy further than it's already taken place so far. Okay? Fascinating turn of events. And the economic sanctions, which is almost a new form of warfare, have been rapid and dramatic, and I think were largely unexpected. Trade, U.S. has banned the import of all Russian oil and gas. Honestly, it wasn't that big of a deal. It's only about 8% of our oil and gas markets. Europe is absolutely unable to do so. It's about 40% of their energy markets. Russia has turned off gas to Poland and Bulgaria, demanding some rubles. There's some interesting strategy taking place right now. And then from an optics standpoint, U.S., UK, EU, and Canada launched this transatlantic task force to seize and freeze assets of Russian oligarchs. Now, within the Kremlin, Putin has always been isolated, so this is largely optics, not economics. Nonetheless, it is applying pressure in lots of different ways to try to essentially end this through the economic components. Okay, let me pause for a moment. What's the impact? Handful of points. Number 1, countries around the world are staring at the fact that the US is the world's reserve currency, and in this case could reach its hands out and freeze assets of the central bank. Right? That is scary for countries like China, who have significant amounts of wealth under the US control by and large. So that's a dynamic that I think will have far-reaching implications beyond this war. It's why I really want you to focus on that dynamic. Item number 2, because we've seen such pressure and such shutoff from both wheat, food supplies, oil, energy, that has inflationary pressures. It's a supply shock. So we are shutting down supply of various forms of food and energy, which puts upward pressure on prices of those goods. That is a really significant dynamic. Item number 3, related, countries are now trying to come up with, could they come up with their own form of being the world's reserve currency? China's been working on that for years unsuccessfully. They have a physical version, they have a digital version. They have not yet been able to do so, but we're watching that closely because that could have very significant global trade implications, which leads me to point number 4. We're likely moving away from such a historic globalization model, much more to a values-based regionalization model. We're watching that dynamic really closely as well. I'll touch on that in a moment as well. Last slide here, just because this was largely not focused on, and I want to make everyone aware of it because it's really important strategically. You may have seen headline, U.S. approved $13.6 billion of Ukrainian aid. This was about 6 weeks ago now. Largely ignored. I think that was largely expected. Traditional foreign aid was about $7 billion of it. Military support was $3.5 billion. Interestingly, they were thoughtful about making sure that they were clear that they were only providing support for defensive maneuvers, not for offensive maneuvers. Russia has always used their propaganda machine to say that Western countries would potentially go through Ukraine to invade Russia. We have no interest in doing so, but nonetheless, the U.S. was careful about doing that. Well, here's the one I want you to focus on. $175 million in a couple of small little line items, which is $50 million to the FBI for cyber protection. That has not yet come to fruition in terms of cyber warfare, but that is one to watch. And then this one is fascinating to me. $25 million to the Treasury to enforce sanctions and analyze economic vulnerabilities. And what's happened is, as I mentioned, we're almost in this new version of warfare. because we've got such a global economy now, and we've had this globalization, both on a monetary, fiscal, and trade policy perspectives, we're now deploying significant assets to understand the knock-on effects of the different components. In other words, I've got a large corporation that trades with Russia. Where does that capital flow? How does it flow through the system? And can I, through a handful of different levers, turn off the capital entirely to Russia? So what's essentially taken place is through Putin's decision to invade Ukraine, he has taken the Russian economy to its knees, and estimates are put them back somewhere between 20 and 30 years in terms of economic progress. The next handful of years will have food insecurities, we'll have all sorts of issues for Russian citizens. Unfortunately, that will be disproportionately focused on those that are impoverished, those that don't have access to resources, and you will continue to see a brain drain, a talent drain out of Eastern Europe because of that vulnerability. So it's been probably his largest mistake he's ever made. Unclear how this will all play out, but we were watching really, really, really closely. And if anything, the positive was Western nations came together in a way that was faster, more rapid, and more dramatic than anyone had expected before. And there may be some positive benefits to that over time. We will see. Okay, that's context. I want to make sure you have that because that influences the next section. The next section is inflation. Slow down here for just a moment. Let me define inflation. There's a lot of misinformation about inflation, and I want to touch on what everyone I think knows, but then also something that maybe people don't focus on. Let me give you an example. Imagine I have $10 in my pocket today. I walk into a store and I can buy 10 loaves of bread, right? $10 in my pocket buys 10 loaves of bread. Tomorrow, I have a new $10 and I walk into a store again, same store, and I can now buy 9 loaves of bread, okay? Today I could buy 10, tomorrow I can buy 9. All that's happened, and this is the definition that everyone's aware of, the price of bread went higher, price of goods and services goes higher when inflation moves higher, right? That's the standard definition, what everyone knows. Here's the important point. I'm going to get into this in a second in terms of why this has occurred. When the price of bread moves higher, the value of my dollars, the value of my currency has moved lower. The value of my $10 in my pocket no longer does as much. And so from a monetary perspective, from a fiscal perspective, from an average consumer, the value of dollars we hold in our corporate bank account, in our personal savings accounts, value has gone down. Right? Now that's a really important dynamic that not many people think about, but is equally as important, if not more important, for understanding how this will likely play out. I'll get to that in a second. Here's the data. There's a measure in the United States, I'm sure you're all aware of it. It's called CPI. U.S. Bureau of Labor Statistics puts it out. Honestly, it's flawed. It's not great. But basically what we do is we take a basket of goods, rents, paper towels, cars, and we measure the price of an average basket of goods. And then we look at what the percentage change is over time. Right? Has it gone up? Has it gone down? And so what you'll see, this chart goes back to 2013. This is the 12-month percentage change. This is the chart you're used to seeing, I'm sure. We were sort of bouncing between 2% and 0% for a while. And all of a sudden, we've just screamed north, right? So it's prices have gone up dramatically. Prices have gone up dramatically. Okay, why do we care? Let's start with that question. This chart has 2 lines, goes back to 1962. This first lens we're going to look at is sort of an investor's lens, okay? Focus on the orange line. The orange line is 10-year inflation. So you'll notice it kind of has 2 main sections. From 1962 to 1980, inflation went higher and higher and higher. And from 1980 to 2020, inflation went lower and lower and lower. So up in the beginning, down in the second part, right? Straightforward. 10-year bond yields, that's the blue line. It follows inflation. This is why we care. As inflation moves higher, bond yields move higher. As inflation moves lower, bond yields move lower. And as those 2 things occur, they tend to act similar to each other. Remember, when bond yields go up, bond prices go down. We take losses on our bonds, right? Okay, so that's important information. Let's now update this chart. So this shows the same data, 10-year bond yield, that's the blue line. But now we have 1-year inflation, right? We can't do 10-year inflation because we don't know what it's going to be. But we can look at 1-year inflation and look at the bottom right of that chart. 1-year inflation is taken off and 10-year bond yields have hardly moved. They've moved a little, a very large, it's been a really painful move in the bond yield relative to what we're used to. So one of two things now has to happen. Either inflation will slow, because these always converge, or the bond yields will rise. That is one of two things will have to happen. And this is why we care. As investors, particularly those of us that hold actual bonds or things that are related to bonds, if inflation takes off and the Fed doesn't get it under control, bond yields will move much higher. We will all take losses on the bonds themselves. We'll have all sorts of far-reaching implications for the economy, for recession possibilities, et cetera, et cetera, et cetera. I'll get to that in just a moment. But this is context and why we care. The question is why? Okay, and that gets me to this chart. Why has this happened? Number one, pent-up demand from COVID, right? We all know this. We as consumers largely stayed home. We didn't travel. We didn't go to restaurants. A lot of demand was sort of shelved for a little while. That's largely changed as the world has become more normal, but will eventually roll off. That's item number one. Item number two, supply chain disruptions. Right? David talked about it at the beginning. The world's ports, world's economies shut down either because of loss of goods, loss of access to goods, or simply because manufacturers shut down. So supply chain definitely disrupted. Here's the third one. Here's this chart, U.S. Federal Reserve balance sheet. The axis here is in millions of dollars. So 1 million millions is $1 trillion, okay? Remember, the U.S. economy in its entirety is around $21 trillion. And the U.S. Federal Reserve has two main goals. They want to keep prices stable, and they want to have maximum employment. Okay? So there was this tool that they really didn't use up until the global financial crisis. It was called balance sheet expansion. Here's what happens. In 2002, there's about $750 billion of usage. Global financial crisis happens, and they're searching around. How can we essentially stopgap the market? How can we provide liquidity to banks to prevent the credit system from falling apart, the banking system falling apart? And they remember this tool, and here's basically how it works. Someone in the Federal Reserve goes on, turns the computer on, click a couple buttons, and out comes some currency. Now I'm simplifying, but by and large, out comes some dollars. Dollars get created out of thin air. They walk across the hall. They use those dollars to go out into the market and buy bonds, physical bonds. They could buy mortgages. The Japanese central bank actually bought stocks. But they basically create dollars out of thin air, and they flood the market with that liquidity. What happens if you're holding a bond, someone now bought it from you, you now have cash, you can go buy something else. And it just starts the process of distributing liquidity throughout the marketplace. Well, look what happens. In 2007, 2008, largest financial crisis we've had in a very long time, we take about $1.5 trillion and create it out of thin air, right? We go from $750 billion to around almost $3 trillion. And then the crisis is over. This largely works, by the way, provides liquidity. And we go to $3 trillion, to $4 trillion, to $4.5 trillion. And we kind of get through it. Some of the bonds mature, starts to shrink again in late 2017. And then all of a sudden, COVID-19 hits. And what happens? We create about another $4 trillion almost overnight. Massive, massive influx of liquidity. Remember, the entire U.S. economy is $21 trillion. We just created another $4 trillion. Now add on top of it fiscal policy, right? We just sent a bunch of money into people's bank accounts. We did a bunch of Support America sort of stuff. All fine. I'm not arguing whether that was the right decision or not. Nonetheless, massive amount of liquidity gets put into the system. Well, remember my example with bread, right? We have inflation, which is the rise of price in goods and services. But when the dollar value goes down, it's the counterpoint for inflation moving higher. So if I have two countries, each have 100 units of currency, and one just doubles the amount of currency, by definition, it's worth less, which means by definition, prices are higher, right? The value of the currency goes down, prices of value of goods and services goes up. So we largely, at least in part, created that ourselves. I'm not arguing it's right or wrong. In fact, it really saved us in 2007, 2008. But boy, now you go the opposite direction. Federal Reserve says, whoops, inflation is too high. I've got to pull liquidity out of the market. I've got to pull it out now. When I put it in, prices of goods and services, prices of financial assets, houses, car markets all went up. Now I raise rates, I pull liquidity out. By definition, things are going to reset, right? We're going to get back to a different now level of economic focus from the Federal Reserve, which means by definition, the cost of capital is moving higher. The cost of goods and services are moving higher. And until the Federal Reserve catches up, we're going to see that continue for a little while, right? That's a healthy reset, I would argue. What does it put us into recession? Possibly. We've seen 1/4 of economic contraction, but it's a healthy reset for the Federal Reserve to begin focusing on the economy and not as much on markets. And they've got to get that inflation under control in order for us to then, again, refocus on what is the primary objective of the Federal Reserve. So markets are going through a bit of a tantrum right now, understandably. What has been an unlimited amount of liquidity is now changing, and we're having to adjust appropriately. What does that mean for everyone? Number one, during this time period, cash is a tough place to be. If I own $100 of cash, by definition, next year, I'm only going to purchase roughly $92 worth of goods because inflation is taking everything higher. So I'm losing purchasing power by holding cash. Be careful with cash. Number two, bonds is an asymmetric risk there right now, right? They're valuable, especially now that they've been some reset already. But we got to be careful with bonds going out on that fixed income curve. You can take a lot of volatility without a lot of yield. Let's make sure we're balancing that, especially if Fed doesn't get ahead of this. Yields could move higher and bonds could reset. So bonds are a little tricky these days. Turn more towards things like inflation-linked bonds, hard assets, some of the real estate markets, potentially some of the municipalities have infrastructure, some alternatives, all interesting areas when inflation starts to take off, and build that diversified portfolio to help with those areas, because cash in particular can be dangerous during this type of market, setting aside emotional reasons or short-term needs, which are, again, very, very important. Last point I'll make on this, and then I'm going to zoom out here in a moment. 12-month change in U.S. inflation. This goes back to 1948. Here's the point. It's very high relative to the last 40 years, but it's been like this before. We're going to get through it. We're going to be fine. The U.S. has the world's most sophisticated and honestly autonomous Federal Reserve central banking system, who understands what happened in the Weimar Republic in the 19-teens, who understands what happened in Venezuela and Zimbabwe when Volcker was in office in 1980. They understand these things. They study them well. We're going to get through this. It's a tricky environment because inflation is rising and growth is slowing. That's something called stagflation. Nonetheless, we're going to move through this. The incentives that drive markets have not changed. Capital markets are an extension of capitalism. Companies are still incentivized to grow net income, to grow cash flows, to capture market share, to be thoughtful and strategic. And we as investors are still incentivized to give them our capital, so we return or essentially receive dividend payments, cash flow, et cetera, in the form of dividends or coupons. That dynamic has not changed. So building great diversified portfolios, focusing on the long term, is really what's valuable during times like this. Try to control the things that we can control and focus on the things that we can't, but also try to avoid the emotional decisions. Okay, last sections, lessons from history. We'll wrap it up with questions. Hopefully we're on track here. A couple slides. Again, just perspective here. Let's zoom out a moment. We went back and looked at 6 different military involvements, right? Iraq War, Korean War, World War II, Vietnam, Bay of Pigs, and Gulf War. And we just looked at how markets did, right? So we took from when the military event occurred, when it began, 5 years forward, and put all of those on the same chart. And each of these has its own dynamics, right? Each of them has its own poor decisions, its own tragedy, its own, again, geopolitical events, its own monetary policy, fiscal impact, et cetera, et cetera, et cetera. And here's the point, right? Over time, markets tend to reward those that can provide capital for productive purposes. And the chart, by and large, goes from bottom left to top right. Average annual price return before dividends is 8.1% during all of these different wars. Could this time be different? Absolutely. But incentives drive behavior, and I rely on those incentives over and over and over again. Next chart. This goes back to 1980 and asks some very simple questions. Number one, red dot. Show me the maximum loss in each year. That's the red dot. 1980, markets lost 17% at one point. 1981, they lost 18%. 1982, they lost 17%. And that plots those red dots. The blue line It's just the calendar, the blue bars, just a calendar year return from January 1 through December 31st. How did markets do? And I love this chart in its simplicity for the following reasons. It simply shows you that every single year has some losses. It's a natural part of resetting capital markets. And yet in aggregate, markets return positive returns over the long period of time. That's the thing to focus on. Lastly, chart 3, and I'll stop here. This goes back to 1980, looks at the S&P 500 and starts essentially with the growth of $1, growth of $10,000. Does this in compounded percent return. And if you had stayed invested from 1980 up until now, this was as of Friday afternoon, your total return was around 8,687%. You take $10,000 starting in 1980, and that's around, roughly speaking, worth $450,000 today, right? Dramatic returns. That's despite 6 markets that lost more than 20%. 6 sell-offs over this time period that lost more than 20%. Fairly equal spaced. Yes, there were periods that were better than others. Yes, there were painful times. Yes, these markets are scary. And every single time, when you go back and look at headlines around the global financial crisis, the crash of 87, or the embargo shock of 73, people were calling for the end of capitalism, a return to communism, the end of banking, the end of capital market. We as humans, in the moment, right, our amygdalas fire up, we focus on the fear, and we oftentimes are not great at making decisions. Slow down, focus on the principles, focus on capitalism, focusing on the incentives that drive behavior. I don't know what's going to happen to markets. I do know that incentives drive markets, and over time I can rely on those principles generally to deliver strong returns in excess of inflation. Okay, with that, I will stop talking. I'm happy to open it up to questions. Happy to open it up to any form of engagement, honestly. And if I don't know the answer, I'll tell you that, and happy to engage offline as well.
My mind is just blown. I appreciate you being here today and creating this and explaining it. And I do have a few questions. One of the first ones is, how many quarters of contraction actually equal a recession? Is that just 4 or?
Yeah, good question. So there are a handful of different definitions. The one that's the primary definition is 2 quarters of contraction. We've just had one. We are seeing forms of retraction or economic contraction in a handful of different places. China today, for example, just announced that they thought it may be the first quarter in a long time that they won't have positive growth. Honestly, the U.S., interestingly this time, and why my forecast is generally that if we have a recession, it'll be a shallow recession. That's my modal outcome, my modal guess right now. The U.S. economy is in a decent place. We have not taken on a lot of debt. That's one of the largest causes of deep contractions. We don't have that from a consumer perspective. Some portions of the business market do, but in aggregate we don't. Our in a handful of ways, our federal debt has actually been a little bit more moderate recently. So in a couple of ways, we have not gone out very far on the leverage curve, which is one of the large causes of deep recessions. There are a lot of challenges out there, to be clear. This year I expect to be bumpy. It's a tricky market, and it's one of the trickier markets that's been out there. But it typically is just 2 quarters of U.S. growth contraction, nominal growth contraction, that defines a recession.
And then just I don't know, random kind of question. These inflation levels, like you talked about the cost of bread and how that's changed. Do you think that that's the new cost of bread from here forward, or do you still see it coming down to a more reasonable prices, or are these kind of our new costs that we're looking at now?
Yeah, good question. So here's my expectation. Let me go back to this chart as well. Expectation right now, if you look out kind of 3 or 4 months in the gas energy curves, things are starting to tip over, starting to tip over. We just saw the single largest contraction in new home starts, 16% in many years. We're starting to see a couple of these things starting to slow. So could we get an additional real acceleration? Absolutely. But to the extent we start to see demand slow from this pent-up COVID issue that I mentioned, we start to see ports open up again. We're seeing some interesting data coming out about the fall expectations for shipping and transport. And to the extent we see a little bit of relief in the Eastern Europe conflict, we've also seen additional suppliers come online. OPEC is cranking up energy. We've seen a couple of folks like Venezuela. We've allowed some additional transport there. We've also seen fracking produce its output, so increase its output. So to the extent we see a little relief and you start to see the inflation curve turn over, that oftentimes is a psychological impact, and people start to go, okay, we're going to be okay. And prices start to stabilize a little bit. Sort of the fear dynamic comes out, and we can hopefully have that positive feedback loop. So my modal outcome is prices will stay high for the next 4, 6, 8 months, somewhere in that ballpark. We're likely going to see gas prices. I know you're already over $6 in California, but nationwide we'll probably continue to see that move a little bit higher at the pump. And then things should, if we get to a reasonable place, the Fed will likely raise 1 or 2 more times. Things will start to stabilize a little bit and we'll start to revert. Now, I think we'll be at a higher level of inflation for the next handful of years, meaning we won't be at the 0 to 2%. We'll be in the 2 to 4%, 2 to 5% range. And honestly, some of that is not bad. Some of that is not bad. It actually allows us to inflate our way out of some debt. But nonetheless, I don't expect us to get to the Venezuela, Zimbabwe hyperinflation regime. We are the world's reserve currency. That affords us with so much privilege. We're geopolitically and geographically distant from Eastern Europe. That is a bunch of benefit as well. We are a safe haven asset. And as long as we don't overprint currency or overstimulate fiscally, then we'll be fine and we'll move right through this.
And then just lastly, what do you think the future of the Federal Reserve looks like? I mean, are we seeing the height of that, or okay?
Great question. So there's some really interesting dynamics taking place there, and I want to make sure this is clear. This is my personal opinion as opposed to Freedom MassMutual, but because it's a little controversial. Since the mid '90s, the Federal Reserve is very much focused on markets, in my opinion, more than the economy, and I think that was a mistake. I think that the Federal Reserve should largely be driven by what is the real economy doing, maximum inflation or maximum employment and stable prices, not how the market is doing. Since about mid '90s, it started to really focus on if the market got hammered, they would lower rates really quickly. I believe Powell is really trying to change that, and I think that's very healthy for the U.S. economy. If the central bank can get back to focusing on the real economy, actual production, I think we'll have a more stable output. We'll have less highs and lows. We'll have steadier GDP growth if they have the ability to do so. That's a tricky thing to navigate, but I'm generally positive thinking about that dynamic. I think we've gone too far for stimulating in the last handful of years. Per that chart earlier where I showed the $4 trillion of creation out of thin air. But I think if we can contract that, then I'm very optimistic. I will say we're watching that very closely. And if the Federal Reserve were to crank up that throughput, more currency being printed, more bonds being purchased, we would be a little bit more nervous about this sort of next level of inflation. We're not seeing that yet. So we like what we see right now.
Well, thank you for that. David?
So, Daken, are you saying that I should really trade in my car and get an EV? I mean, it sounds like gas prices are going to be there for a while. So now's the time that I need to just bite the bullet and go get that EV, right?
Well, so a couple of interesting points. Please
say yes. That way I can go to my spouse and say, yes, Daken recommended that I get a new car.
I will say, if you look at energy generation, electric generation in this country, there's a little bit of a fallacy where it's important to break down what is actually creating that energy, because there is a significant amount of, for example, the United States, coal production that generates electricity. That's not a very smart dynamic. I do believe that in the next handful of months, gas prices will probably continue to go higher before they start to go lower. I think the likelihood of getting back down to $2 a gallon gasoline is almost zero. It is a fossil fuel, which means there's a finite amount of supply. And so I think we will continue to transition over time. You've seen countries like Germany, for example, say explicitly, we're going to sacrifice our growth so that we can move to a cleaner form of energy. That's a really difficult decision for a country to make. Over time, I think we'll continue to find other resources to do so. But in the near term, I do believe that gas will continue to move higher before it starts to slow, but we'll never get back.
Oh no, I'm gonna stop you there because I'm just going to use that first part. So I really want to get that new Mustang Mach, the SUV. I've been wanting for it. So as long as you say the gasoline prices are going to keep going for the next few months, that's going to be my excuse.
Right. Just use it's the Economist day. You can say what's happening, just not when it's happening. Say prices
exactly.
Higher.
Katie, let's go for a test drive. After this, we'll go for a test drive. How's
Sounds
that?
great. Meet you there.
Okay.
Any other questions from you, David?
No, this is great. I really appreciate you taking time to present this to the chamber and the community.
Absolutely. If you have any other questions after, feel free to email me or reach out. Happy to engage offline as well. Thanks for the time.
Well, thanks so much for joining us today, and promise to come back and give us an update, keep us posted on how things are going, and we'll be sure to kind of hold you accountable to all of these different graphs and charts and say, hey, but you said. I'm just kidding, but it does feel good to, hear from you. You guys have your pulse on everything that's happening. And for a lot of small business owners, they're so consumed with the day-to-day in their business that this is all can be very confusing and overwhelming. So I really do appreciate the time today, because we're going to send this out to all of our businesses locally and make sure that folks are just staying informed, a little bit in tune and in touch. So we really would love for you to come back and share more maybe next quarter.
Sounds great. Looking forward to it.
All right. We'll see you soon, my friend.
Thanks,
and David, before we sign off. Yeah. Thank you so much for being an amazing member of the chamber and community, one of our ambassadors, and bringing in some of these experts to come and keep us informed. We really appreciate it.
Yeah, we really love to be, us, it's all about giving information. I think the more information you have to make decisions for your financial future, I think that's very helpful. And, I, in particular, that I love working with business owners. And as you said, they're so concentrated on the day-to-day operations, and just having a little bit of knowledge about what's happening out there that will eventually affect them on down the line. I think it's very important. Give knowledge.
That's right. Very much so. And for those of you watching, David Morgan's information, his emails on the screen, as well as Daken's. And we look forward to seeing you guys again. Please come back and keep us posted on how folks can prepare for the future. And thanks for all that you do. We appreciate you.
Thank you. I appreciate it. Good day.
Good friend. And thanks so much for joining us again today on Live with Your Chamber. It's absolutely our pleasure to bring you local experts to share knowledge, information. If there's a way that we can help you professionally or your business or nonprofit, please don't hesitate to reach out. That's what your Chamber of Commerce is here for. Look forward to seeing you soon. Take care.